Have you ever heard the term claims-made policy and thought, wait, what does that even mean? Don't worry, in this video, we'll break it down in simple terms. Welcome to Insurance World TV, where we make insurance simple, relevant, and practical. Today, we're exploring an insurance term that often confuses many, but is absolutely vital for professionals. The claims-made policy. What is it? How does it work? And why should you care? Stick around and let's break it down together by answering a series of relevant questions, the Insurance World TV way. Let's dive in. Question 1. What is a claims-made policy? A claims-made policy is a type of insurance that only covers claims that are made or reported during the period the policy is active, regardless of when the incident, loss, error, or negligence actually occurred, as long as it was after a specified retroactive date. Think of it as a mobile phone plan. You can only use it while it's active. If you stop paying and cancel the plan, you lose access, even to old text messages. But there's a catch. The event must have occurred after a special date called the retroactive date. So, in simple terms, the claim must have been made now, and the mistake must have happened after your cover started. So, here's the key idea. The claim must be reported while your policy is still running. If you cancel or forget to renew, future claims, even from past events, might not be covered. There are 3 things you need to understand. 1. Trigger. The claim has to be made while the policy is active. 2. Retroactive date. Your policy won't cover anything that happened before this date. 3. Reporting requirement. You must report the claim within the policy period or within a special window called a tail period. Question 2. Where are claims-made policies commonly used? Claims-made policies are particularly prevalent in professional liability insurance, especially in sectors where the consequences of errors, omissions, or negligence may not surface until months, or even years, after the original service was rendered. Such policies are designed to provide protection only if the claim is made and reported during the active period of the policy, or during an extended reporting window, if applicable. This makes them ideal for industries where long-tail liability risks exist. Here are key professions and insurance types where claims-made coverage is widely used. 1. Medical professionals, medical malpractice insurance. Doctors, surgeons, nurses, and other healthcare providers are frequently exposed to malpractice claims long after a patient has been treated. A patient may discover a surgical error or misdiagnosis years later. A claims-made malpractice policy ensures the healthcare provider is protected if the claim is reported during the policy period, even if the incident happened years earlier, provided it's after the retroactive date. 2. Legal practitioners, professional indemnity insurance. Lawyers and advocates face exposure to claims of negligence, breach of duty, or failure to properly advise clients. Due to the often complex and delayed nature of legal proceedings, a claim might arise long after the advice or representation was provided. Claims-made coverage aligns well with this delayed risk profile. 3. Engineers, architects and surveyors, errors and omissions insurance. Design flaws or construction oversights may not become apparent until long after a project is completed. An architect, for instance, may be held liable for structural defects years down the line. A claims-made E&O policy allows such professionals to respond to these delayed claims as long as they report them during the policy term. 4. Corporate executives, directors, and officers' liability insurance. Company directors and senior executives are increasingly being held accountable for decisions that may result in legal or regulatory action months or years later. Claims-made D&O policies are structured to provide a safety net for such leaders, covering allegations of mismanagement, breach of duty, or corporate governance violations when claims arise post-tenure. 5. Technology and cyber professionals, cyber liability and tech errors and omissions. In the fast-evolving digital space, cyber breaches, data leaks, and software errors may not be immediately discovered. IT consultants, software developers, and cybersecurity professionals often carry claims-made cyber liability or technology E&O policies to protect against claims related to delayed discovery of faults, breaches, or negligence in digital service delivery. In summary, claims-made policies are the preferred form of liability insurance in professions that involve complex services, delayed consequences, and extended liability periods. They are particularly suited to regulated professions such as healthcare, legal, finance, technical fields with latent risks like engineering, information technology, leadership roles in high-stakes environments such as board-level executives. Understanding how these policies work and ensuring that coverage is continuous and well-managed is essential for any professional facing potential long-term liability exposure. Question 3. How does a claims-made policy apply? A claims-made insurance policy applies when two conditions are met. The claim is made and reported, while the policy is active or within an extended reporting period, also called tail coverage. The incident or act that gave rise to the claim happened on or after the retroactive date of the policy. This means that both when the claim is made and when the act occurred are important, but the date the claim is made is what activates coverage. Real-life example: a medical professional. Dr. Akinyi, a practicing gynecologist in Nairobi, has a policy whose start date is January 1st, 2020, with a retroactive date of January 1st, 2018. Policy is renewed annually until December 31st, 2023. Policy type: claims-made medical malpractice policy. Scenario: in February 2024, a former patient files a legal claim against Dr. Akinyi, alleging that a surgical error occurred during a procedure back in October 2019. Is she covered? Let's analyze the situation. Did the claim arise after the retroactive date? Yes, the procedure occurred in 2019, which is after the retroactive date of 2018. Was the claim made while the policy was active? No. The policy ended in December 2023, and no tail cover was purchased. Result: Dr. Akinyi is not covered because the claim came after the policy lapsed. Even though the surgery was within the retroactive period, the claim was not made while the policy was active. The same example. Now, with tail coverage. Now, imagine Dr. Akinyi had purchased a 3-year tail cover when she retired in December 2023. The claim arrives in February 2024. Tail coverage extends the time allowed to report claims, even after policy expiry. The surgery was still after the retroactive date. Result: Dr. Akinyi is covered under the tail coverage. Key takeaway: With a claims-made policy, it's not enough that the incident happened during the policy term. The claim must also be made and reported during that time, or within the tail coverage period. That's what activates your protection. Question 4. What are the pros and cons? When it comes to claims-made insurance policies, there are a few clear advantages and some cautions you should be aware of. Let's start with the pros. First, claims-made policies usually have lower premiums at the beginning, which makes them more affordable for startups, solo practitioners, or young professionals entering the field. Second, they're ideal for professions with long-tail risks. That means jobs where legal or financial claims may not arise until years after the work is done. Think doctors, legal advisors, IT consultants, engineers, and more. Now, let's talk about the cons.
1.
These policies can be confusing, especially for people who are new to professional insurance. If you don't understand terms like retroactive date or tail coverage, you could unknowingly leave yourself exposed. 2. They require careful management. Unlike occurrence policies, you can't just cancel and forget. If you end your policy without buying tail cover, you might lose protection for past work. 3. Risk of coverage gaps. A small oversight, like missing a renewal date or switching insurers without a prior acts clause, could leave you exposed and unprotected. So before you pick a claims-made policy, understand the rules, maintain continuous coverage, and work with a knowledgeable broker. That small effort can make the difference between being protected or fully liable. Question 5. How can you buy back some of the limitations of a claims-made policy? Claims-made policies come with certain restrictions, especially around when a claim must be made and when the incident happened. However, insurance providers offer a few smart options, known as policy extensions or endorsements, that allow you to buy back or reduce these limitations. Let's break them down. Option 1. Tail coverage, also known as extended reporting period, or ERP for short. Tail coverage allows you to report claims after the policy has ended for incidents that occur during the time you had active coverage. It is ideal for retiring professionals, closing a business, or switching to a different insurer.
Tip.
Tail coverage can be purchased for 1, 3, 5 years, or even indefinitely, depending on the insurer. The second option is nose coverage, also known as prior acts coverage. This coverage lets your new policy cover incidents that happened before the new policy started, as long as the claim is made during the current policy term. Nose coverage is ideal for professionals switching insurers but wanting to stay protected for past work. Tip. Always check the retroactive date on the new policy to make sure it goes back far enough. Option number 3 is through backdating the retroactive date. You can request to move the retroactive date further back in time, increasing the number of past incidents that are covered. This is ideal for newly insured professionals who want to be protected for work done before buying the policy. Caution. This usually comes with a higher premium and depends on your risk profile. Fourth buyback option is by adding supplemental coverage or higher limits. You can add endorsements to extend the scope of coverage, raise your limits, or include services that are often excluded, like cyber liability or reputational damage. It is ideal for professionals with evolving or specialized risks. Final advice. If you're concerned about the limitations of your claims-made policy, talk to your broker about tail and nose options. Don't let your policy lapse without a transition plan. Review your retroactive date every renewal. Consider a bundled approach with occurrence policies where applicable. If you're in a profession like medicine, law, finance, or consulting, chances are your liability policy is claims made. Always check your retroactive date. Don't let the policy lapse, and talk to your broker about tail or nose cover. That knowledge alone can save your career. Thanks for watching Insurance World TV. If this video helped you understand claims-made policies, give it a like, share it, and subscribe for more simplified insurance insights. Got questions? Drop them in the comments below. We reply to everyone. See you in the next one.